Hi, this is ProACT Sam. Welcome to this live webinar, Wednesday webinar, where we're looking at planning to save capital gains tax from a UK perspective. So we're looking at how capital gains tax can be saved for expats living and working abroad who's got property or business or investments based in the UK. So first of all, what is capital gains tax charged on? And noting that capital gains tax, we're talking about it from a UK perspective, but capital gains tax can apply in lots of countries around the world. But in the UK, the tax is charged on any personal item of value that you can then subsequently sell. Okay. Now, the conditions to that, but essentially that could mean a stamp collection, a magazine collection. It could mean a work of art, it can mean jewellery, and it could mean property, it could mean business and investments and shares. It could be a stamp collection, and there's a peculiar term that is used in capital gains to understand whether something has got a value and therefore it can be taxed for capital gains. And it's called wasting assets. So if something will, over a period of say 50 years, depreciate to have no value, then it is deemed to be a wasting asset and capital gains tax won't apply. It's whether it will endure. So things that we would consider to be collectible antiques and would appreciate in value are the things that acquire a capital gains liability. Shares and investments are subject to capital gains. So if you invest in the stock market and the share price goes up, that in creating a capital gain. Ditto, the same applies for cryptocurrencies. So as we get more and more invested into cryptocurrencies, these investments as well are potentially liable to a capital gains tax on disposal. So it's being aware of that. I mean, if you're going to double your portfolio in 2 years and take 10,000 to be 20,000 or 100,000 to be 200 or 1 million to be 2 million, you're creating a capital gains tax liability. The same is true for any type of shares. So it could be stocks and shares, it could be shares in your own company, which you're building a liability as a capital gains. Employees who have share saving schemes or any sort of employee benefit scheme, again, it becomes a capital gains liability for them in the future. Property is a fixed asset, obviously in the country in which it's in, and again, a capital gains tax liability can apply to that. Now, in the UK, people are used to their residential property being capital gains tax free. But what you need to bear in mind is that the rules have been tightened up a lot in the last 5 years, and your residential home can be capital gains tax free, but for expats there's dangers and planning and protection that needs to take place to make sure that the residential home doesn't suffer from capital gains tax. From 2020, the capital gains tax on residential property, as opposed to any other type of property, is 18 or 28%, depending if you're a high rate taxpayer or not. So there's a lot at stake for expats with UK property invested. Any sort of business assets, including intangible assets. So if you've got a copyright, a brand name that you're licensing or selling while you're living or working abroad or cross-border, then the sale of that can potentially give you a capital gains liability, if not income tax or property rights, royalty tax. So these are some of the ideas that are potentially liable to capital gains. Now, what is precisely taxed for capital gains in the UK is not necessarily taxed in another jurisdiction. And this is where expats can take advantage of the rules to try and mitigate capital gains tax. So in this webinar, we're looking at from a UK perspective, but the principles for capital gains apply around the world. However, when you get certain jurisdictions, they may not apply a capital gains tax at all. So the UK have had a capital gains tax for about 50 years. Other countries don't have a capital gains tax. So if you use Cyprus, a modern EU state with an investor-friendly environment for tax planning, for relocation, for IT business, for financial business, or just for expats to be used as a tax residence base, there's no capital gains on investments. The only capital gains in Cyprus is on Cyprus property assets, not on investments, not on inheritances, not on anything else. Because the other thing about capital gains is that it's a lifetime disposal. When you die, you can avoid capital gains, but you then got inheritance tax. And that's another issue which we'll come back to later. So let's have a look at what the capital gains tax rates are for the UK. So generally, it is 10% is if you're a basic rate taxpayer, or 20% if you're a high rate taxpayer. But bear in mind that the capital gain can have an influence on that, or any gifting or other plans that you take can, on the margins, move you between a high rate and a low rate taxpayer. The personal home in the UK is exempt as long as you're living in that. So expats who maintain a home in the UK, to actually maintain that capital gains tax-free liability, have to be in that property, live in that property for 90 days in a year. So it then becomes a tie issue and a residency issue as to whether you're an expat or non-resident or not, which can have an obligation. The good thing with capital gains tax is, in addition to any personal allowance, there's a capital gains tax allowance each year. So anybody can make 12,300 capital gains a year tax-free, and that's the husband and the wife. So sharing it in the family does help that. But as part of the post-COVID regulations, that capital gains a personal allowance has been fixed through to 2026. So there can be no increases. So as inflation builds up and increases the prices of property in the UK and other jurisdictions around the world, the capital gains is going to accelerate, and with the UK, the personal allowance is going to be a depreciating benefit. Buying and selling costs of property or any other investments are allowable when you're selling a property. So if you're selling for 15,000 gain and you've got 3,000 expenses, it's going to bring you below the personal allowance. But also if you've got losses, so if you've got an investment portfolio and you make a loss on a Bitcoin, a crypto investment, or a share, you could sell that gain, that loss in a year, and offset that against gains elsewhere. So that's another tactic that you can use. And gifting between partners, whether they're spouse or civil marriage, civil partnership, those gifts are tax-free, but not necessarily to children. However, you can make a gift to the children which is exempt under inheritance tax rules. So lifetime gifts to the family can enable you to avoid a capital gains liability on that asset. If you make investments within the UK, this is not our business directly, but if you're making investments into pensions or ISAs, that's a way to keep your assets tax-free. But for expats living and working abroad, they can't necessarily add to a UK ISA under the rules as non-residents. And pensions, there will be another way. And if you want to talk to a ProACT investment advisor, we can arrange a free review. by contacting us at proactpartnership.com. We mentioned earlier that shares are subject to capital gains, and if you've got a business and you build it up over the long term, and at least 2 years, if you're buying and selling a business, then that business qualifies for a business relief or entrepreneurs relief as it used to be known. The good news about that is if you sell your business for £1 million, using the business relief exemption, you only pay 10% capital gains. You don't pay the rate, higher rate. So that can be, say, 50%, half of the capital gains tax liability. So that's the scenario. Capital gains is very, very complicated. But essentially, if any asset is fixed in the UK, whether it's shares, whether it's crypto, whether it's your personal residence or your company's residence, or whether it's a property or the assets that you're selling, then there's a capital gains tax liability in the UK. So let's have a look at how you can plan to avoid that. So we mentioned earlier that you've got a personal allowance. That personal allowance is 12,300, and that's going to remain for the next 5 years. So let's just say that is it. You need to use that each year. So if you've got an investment portfolio and you're an active investor, then you need to sell your gains each year to use your personal allowance and report that on your UK tax return. So expats living and working abroad with UK share portfolios or crypto portfolios where they're realising a gain each year, they need to report that on their UK tax return under the capital gains section. And the ProACT expat tax experts can help you with the UK tax return. Our series next in January, we're looking at UK tax returns for expats. So you can contact us if you need any help on that to complete an outstanding 2020-21 tax return, which is due by the end of January. So the annual allowance, you can make a gain, and you need to do that before that sale before the 5th of January, at the end of the UK tax year. You can gift to partners. So if somebody's built up a business and that value is in one, the husband or the wife or the partner, the civil partner, gifting between spouses is exempt. So if you've got a business or a commercial property asset that you're going to sell for 50,000 by gifting it, so it's 25, then it can enable you to keep it to a basic rate capital gains tax, or and also allow both partners to use their maximum 12,300 allowance. So an expat couple owning a UK residential property that they're selling with a capital gains tax liability in the UK will both get an exemption of 12,300 in each of the years. You could split that. There's a timing issue as well. So if an expat couple could, for example, consider selling a part of their property to their 2 children, and that would enable the parents to use an allowance, their personal allowance for the year, and retain an asset which they can then dispose of in the following year. So they do the sale every 2 years rather than 1 year. So that would be another way forward. You can also reinvest it in tax shelters. Now, if you're living in the UK, you would invest in pensions and ISAs as an investment tax shelter. But expats and family and with business that want to protect their assets in the long run, they may consider using a family trust. So for expats living across border and considering down generations, a family trust is a way to hold assets, manage them across borders under one jurisdiction, one control, with a family in control. And it can actually also be a way, not necessarily to avoid capital gains, but if you then get into using the inheritance tax rules, you can gift into there, not just to avoid capital gains now, but to avoid inheritance tax at a later date. So capital gains tax in the UK is running at 10, 20 or 18 to 28% for residential property, but then it goes up to 40% when you die and inheritance tax kicks in. So a family trust for expats to hold overseas property, business assets as well as UK business assets can be a very tax effective way of avoiding capital gains and inheritance tax while the family retains control. The key thing is that we're looking at is property. There's lots of people invested in property in the UK, and inflation is rampant in the UK property sector, and it's set to continue for the next few years as the society adjusts to remote working and hybrid working between remote locations and home. This is going to become more ingrained, and we learn to adapt to it over the last couple of years. But in the coming years, you can work in the suburbs and not travel into London to do your work remotely. But also you can come to a jurisdiction like Cyprus, which are very happy for you to do your employment work under a UK contract and be a Cyprus tax resident. And there you can enjoy all sorts of benefits like 0% tax on dividends, no capital gains tax, as well as up to a 50% income tax deduction for being an individual tax resident in Cyprus, carrying out work in the UK, for example, or any other jurisdiction. That remote working is driving property prices in the UK. That inflation will create more potential capital gains liabilities. By gifting and protecting those assets, expats can protect future capital gains liabilities and inheritance tax liabilities and complicated delays and expenses because of cross-border legislation in controlling those assets. An expat needs to spend at least 90 days in a UK property to maintain the main property exemption residence. That's very, very important. So if an expat's living and working abroad, they maintain a property in the UK without necessarily renting it, it can still fall foul of the UK capital gains legislation with a tax charge on sale of up to 28%. And because the UK tax rules have changed now from 2020, any capital gains tax sale of in the UK of a residential property or any property has to be reported within 2 months. So not only do you report the capital gains tax at the end of the tax year, but you also need to report it straight away during the tax year. So again, if an expat is trying to sell a UK property and they've got a tax return to do, ProACT tax experts can help them with that, to do that capital gains tax compliance return initially, and then again at the end of the year with a full return to add the non-residents and the capital gains sections, amendments to the main tax return. If you live in a property and you've got a lodger, that's not counted as a commercial element. But if an expat leaves their main residence and goes abroad, then that property, unless they nominate it and make it clear with the HMRC and it's not rented out commercially, is potentially then liable to capital gains tax. There is a window, a final period. So if you vacate a property and to sell it, the UK allow a nominal 9-month period for an expat to leave the property, go abroad and get the sale completed and still treat it absolutely as their main residence. So if you lived in that property for 5, 10, 20 years, relocate abroad, and you sell it within 9 months of becoming non-resident and expat, so if you leave quickly on the 5th of April to become expat, then you've got 9 months and you still won't have a capital gains liability for that residential property sale. If you hold on to the property for 3 or 4 or 5 years and you've rented it out in the meanwhile, you could fall foul for all your capital gains to be liable to up to 28% UK capital gains tax sale, even though you're living and working abroad in Cyprus, Spain, Portugal, Florida. So this is something to bear in mind, and as always, planning ahead is the exemption that needs to be made. Now, it's not all bad news for expats. With expat business, if you've got a UK business or UK investments or UK crypto with a gain and you want to sell, if you leave the UK before the end of the tax year, and then after you've left, you then consider selling that property or that business or that, forget property. If you then consider selling that property or that investment or that crypto, then it still applies that UK expats get a generous exemption for that, that allows them to declare the capital gain. So the tax year after you've left the UK, you make a capital gain, you declare that to the UK in full, not for residential property, but for business sales, share sales, investment sales, crypto sales, and the capital gains liability on that, which would be up to 20%, is deferred for up to 5 years. So it's a bit of a staggering scale, but if you stay out of the UK for 5 years, you'll pay 0 capital gains on that. So big business people may relocate to Monaco, Singapore, Cyprus, Spain, sell their UK business, take a large capital gain, and after 5 years that liability in the UK falls away. They can return to the UK with all the capital intact, having saved 20% capital gains tax, capital that can be protected for their family to benefit from, and not the taxman. So that's an important planning tool, and it's important the timing. If you put your business up to sale, you agree the sale, and then you go expat, even if a tax year lapses, that is still going to be liable to UK rules. Now, you might get entrepreneur relief and only pay 10%, but the capital gains is still going to apply. So the tax year end, 5th of April, is an important time to plan. Don't relocate on the 6th of April, because you've then got a whole year of living and working abroad before you can start on the 6th of April next year to commence the process of selling and disposing of any properties. Bearing in mind all the time, UK residential property from 2019-20 is now always going to have a property rental income tax and a property rental capital gains tax. That's not avoidable on any disposal of UK residential property. That's something set in stone. So the way to plan and protect from capital gains on residential property is by gifting and for example, using a family trust and gifting it using the inheritance tax rules rather than the capital gains tax rules. ProACT again have got expertise for expats living and working abroad and for families to protect their property and business assets and investment assets across borders and down generations. We've got a great team of legal and accounting and tax experts that can help advise people. As a general basis, as a first level of entry, we offer a retained client service which allows clients, expats living and working abroad, to engage with us and get access to consultants and questions and answers to help them, guide them every step of the way, planning for whatever their capital gains tax might be. So contact us at proactpartnership.com or join us as a retained client at proactpartnership.co.uk. Next week, the last live webinar of this series in December, so we're going all through the Christmas week. So if you need a break from your December fest, join us next Wednesday for a live Wednesday webinar where we actually look a bit more detail at inheritance tax planning in terms of avoiding capital gains tax as well, and how a family trust or corporation or owning a business through property can help protect assets across borders and down generations. We'll follow that series up in January with UK tax deep dive into capital gains and non-residence and residency issues to protect property, investments and business for expats living and working abroad. So thanks very much for joining us. I hope you've enjoyed it. Go to our website, register and sign up as a retained client, and we'd be glad to talk to you on the other side at proactpartnership.co.uk, and join us with your detailed inquiry at proactpartnership.com. For those of you watching this later after the 2021 Christmas period, ignore the references and watch the series anyway. They'll be available for watch back. We have lots of exclusive stuff for our retained clients online, which you can get access to later on. So thanks for listening, and have a great week ahead. Whatever you're doing, don't worry, be happy.